You're entering CNBC TV18's Fire Safe Studio, powered by Century Ply, now with firewall technology.
Welcome back. We're just about to kick off the market opening, the pre-open at least. Kenneth Andrade is joining us now. He's founder and CEO at Old Bridge Capital Management. Kenneth, it's always a pleasure. Great to have you with us here. Thanks for your time. How are you sort of navigating the current fall that we are seeing in markets, Kenneth? Are you a net buyer of stocks right now, or are you sitting on cash on the sidelines?
What's been happening over the last couple of days, I don't think it was completely unexpected. We've come off a great 2020 and 2021. Okay, and 2022, we did expect it to consolidate a bit, and then we have to look at what the narrative is going forward. And I think 23 is not going to be so bad. So all this consolidation, a sell-off in the marketplace is all in context of an ongoing cycle that you're seeing at this point in time. Of course, there are a number of events that are driving all of this, and the largest reason is increase in interest rates, which is driven by inflation and all that is going around across the world. And for a longest periods, valuations in equities have remained elevated. If interest rates do go up, obviously we'll have to settle for much lower valuations or price earning multiples over the remainder of the decade. So I think once you're aligned to that, it's easier to put a portfolio into place. So that's how we're trying to adapt our portfolio. That's how our portfolio is adapting to the current market environment.
Kenneth, morning. When we spoke to you a couple of months ago, one of your bets were the capital goods, the manufacturing sector.
Yes.
Do you continue to like it? Has there been any change in your opinion of the way the sector is going to be?
I think the better part of this decade, and it started some time back, is going to be all about fixing your supply side. Because whatever we see with inflation out there, and given the disruption that's happened with supply chains across the world, and now with the energy, energy, I think a lot of investment is going to go back into creating all those or reinventing all of those energy chains, and that's all coming home to some of the world's largest economies, whether it's the US, whether it's Europe, and we are doing our own bit as far as that is concerned. So yes, capex is back, and it's back with a very firm footing. We've got a spoiler in the near term because commodity prices are elevated. But going into the future, I don't think we're going to change our view for a very long time right now.
Hi, Kenneth. Always good hearing your thoughts. I recall that you were quite positive on the metals basket. And you had played that theme, in the last couple of years, whether it was the ferrous or the non-ferrous space. Now, a lot of these stocks have come off the recent top. The best is behind? Or, stocks like Hindalco, for case in point, they're down, 25-30%, all of that in the last 1 month or so. View on the ferrous and non-ferrous space from here on?
No, I think if you're looking at corrections in the marketplace, these corrections were given. I mean, there are excesses that are created in the short term, which all get corrected over the cycle. But if you continue to watch, so let's put it this way: if the capex cycle is going to be back, it's going to be material intensive. If it's going to be material intensive, you will have a demand supply mismatch, and this time it will be more or less in basic building materials that are there, and that's what you've seen in the near quarter. So probably one part of the leg is over. We overestimated the near-term volatility of some of these companies, and you've got a corrective. But I will be structurally positive going into like I said, the remainder part of this entire decade on some of these names. So no, the stance is not going to change very, very fast. When we started off the capex cycle somewhere in 2000, it lasted almost a decade. When we kicked off a consumer-driven cycle that was there, it also lasted almost a decade and a little more. So when you come into structures like this, or when you come into a marketplace like this right now, or an economy like this, commodity prices will remain elevated. They're not going to see the same price growth that we saw in the last year and a half, but they will remain elevated.
Kenneth, I know you've stayed away from financials and banks, etc., for a long time. But with the sharp falls we've seen, right? I mean, take HDFC Bank, the market leader, which is now what? I mean, I think under 1,300 at last close. I mean, does anything seem attractive to you?
Okay, from a financial standpoint, our preference is going to be companies that lend against assets. See, what's happening with your environment, right, is that there is a step up in asset prices. Now, whether you're a manufacturing business or whether you're real estate or whether you're any business that has a hard asset on the ground. Now, when you have a step up in asset values, or the asset values are moving up, companies that lend into these kind of businesses will grow faster, because inflation or higher prices or higher capital expenditure is adding to growth in these companies. On the other side, I mean, it's got to be a fairly big dampener for income levels, because while incomes will climb, I think inflation is going to be ahead of income for a better part of this decade. And that's why we probably won't be as optimistic about companies and businesses that are leveraging or that are lending against income levels, right? So there are companies that are focusing on retail financial assets, and there are companies who focus on the capital cycle or financing the capex cycle that is going through, and that's where I think our biases will continue to remain. Companies lending against incomes, I think they will continue, or retail financial companies, they will continue to battle with elevated credit costs. And while you'll have a period like we had in the last quarter where a lot of that got cleaned up, I'm not too sure that this is going to be status quo. It will revert. It will come back again, or growth will slow down in that part of the market. So financials were not negative in that sense. I think valuations are nice, but we have a preference where we want to be in. We'd rather be on the corporate side of lending rather than on the retail side of lending.
Got that. Kenneth, what is your view on the markets on an aggregate basis? There has been a fair amount of reset in investor expectations or even in valuations. Are we close to a bottom, or do you see a sustained downtrend from here on?
I don't have
just to zoom out and get your views in on the big picture.
I don't have a crystal ball for what's happening right now in terms of what markets are and where they are headed. But I'm fairly optimistic, and more optimistic after this correction that has happened. And this comes on the fact that after a fairly long period of time, you will see government balance sheets coming back into the pink of health, right? You can see it with collections, with tax collections across the globe. So that answers a fairly large question that answers a fairly large problem that the world's been grappling with, is how does governments pay off debt? And I think these 1, 2, 3 years will be able to address that part of the problem. The concern here is the cost of borrowings for most of the governments, and if that continues to be elevated, that can also be a slight dampener for that marketplace. But overall, I think the picture is perfect. You've got inflation. Inflation is very good to drive a capex cycle. You've got growth coming back. And once we normalize the situation that is there, I think everyone is going to go back into a capital expenditure cycle of probably a scale that we have never seen before. And that's all very good for corporate earnings. So if you ask me, I'd utilize this down cycle to add on to positions that we have, which we are doing. I don't think holding cash is a solution in an environment like this, because it's not going to help you in the longer term. So you might have a near-term surprise on the downside, but I wouldn't bother about that too much if I've got a constructive view into 2023 and onwards. So it's you're getting stocks cheaper. I think it's about you're getting stocks cheaper, and that's where we are right now.
That's right. Kenneth, in the last few years, the stocks that really did well were some of these platform-related names. Case in point, maybe an India Mart. Stock went one way up. It's half from the recent peak. The other one that did very well was IEX, Exchange. Now, those stocks have given you a sharp correction. I think in the past, you've been reasonably optimistic about some of these themes. Your view on some of these exchanges, platform companies, some of them had run ahead of themselves. But at this juncture, what would your view be?
So I think you said it all. We find valuations demanding there. But structurally, that market or that part of the world is fairly scalable. It's very scalable. And both these names that you talked about are doing their bit as, they don't control valuation, but they definitely control the course of how they grow and how they gather market share. And I can say that I'm not really disappointed by what we've seen so far. So they're good. Valuations are a challenge. They could correct sideways for a very long period of time after this correction. But we remain, I won't say biased right now, but we remain holders of those companies.
Okay, so stay invested in these platform companies. What about insurance as a sector, Kenneth?
Again, the challenge there remains on valuations and how we perceive that part. So we are waiting. I think we will get our opportunity to look at some of these companies over the course of the next couple of years.
Okay, Kenneth, what about these, auto ancillary names? Some of them have seen a sharp correction. Now, they didn't really perform in line with the market in 2021. Indications are that a lot of these, input costs will cool down. Hopefully, this chip shortage issue gets sorted out. And there could be growth drivers as well as margins could improve. How would you view this space, the auto ancs?
I don't think that industry really has pricing power, except for a company or two out there. They don't have pricing power. So it's left to the, they are squeezed on both sides. They can't pass on cost, okay? And they can't control cost because costs are commodity driven and they can't pass it on because the OEMs call the shots out there. So they're good at a valuation. Anytime they get stressed, I think it's a trade there. So they're structural given volume growth, but as far as margins are concerned, they're not going to see a big swing shift either which ways. So it's never going to be a big part of our portfolio. It should never be a big part of anyone's portfolio, except for a company or two who's really getting very large scale, which exists in India.
Kenneth, what about technology? Technology stocks have borne the brunt of the sell-off over here. Most of these tech large caps, mid caps are down 20-30% so far in 2022. Do you think the reset that we've seen in valuations for these IT names have priced in the increase in the cost of capital? Are they adequately, pricing that in? And are they attractive at current levels? Or at what point does the sector turn attractive?
So when you wait for a cycle and when you wait for this market correction to get over, I think the focus will come back onto what's going to be a dominant part of the economy. And tech will always find its way simply because of the scale and the dominance it has across the world, right? So it's not just going to come up in tech because tech addresses the rest of the world. But when you look at any of the other commodity businesses that we talked about earlier, whether it is the ferrous metals or non-ferrous metals, okay, when you talk about the auto ancillary part of the business or even automotive business, I think India is in that sweet spot where you are in a position to be competitive in every single industry today, wherein the raw material is cheap or wherein you've got a competitive advantage. The competitive advantage in tech has always been the lower cost of manpower that we have, or in other words, we are arbitraging per capita incomes of the West versus India. And we continue to remain competitive there. So that story is never going to go out. Then you look at the other building blocks of the economy of exports. And if you look at it from a metals point of view, we are amongst the world's cheapest producer of metals, including iron and steel. So any industry that comes out of this, iron and steel, that effectively is the metal forming business or forgings, castings, stampings, automotive businesses, engineering businesses, we'll have a leg up into it all. So when you highlight all of these corrections, one thing is common that all of them are corrected by 25-30%, whether it's the banks, whether it's IT, whether it's the platform businesses, or whether it's the automotive ancillaries. I don't think that's got anything to do with the environment right now. What is happening is that you've got a reset on the downside as far as valuations are concerned. Then you've got to pick companies that are growing. Our preferences for companies that are now addressing really globally competitive and are going out and getting dominant market share. So, post-COVID, we heard about this China 1+ factor, right? I think that will play out quite considerably over the next a dominant 2023 to 2025 and 26. And all of this will play out also because if you're seeing a global capex cycle that is going to come through, where you have energy bottlenecks and then you have manufacturing bottlenecks and supply bottlenecks, the transition will come in fixing the basic raw materials to build all of that infrastructure everywhere in the globe. And one of the largest destinations will be obviously the United States of America, who accounts for about 23 or 24% of the world GDP. So I think that's the fix that is there. We're not talking about future profitability. We're looking at companies now in all of these businesses, whether it's IT or whether it's in manufacturing, that have the cash flows to invest, and they're not dependent upon external capital, cash flows to invest, to go out and gain larger market share. So if India's IT business is 60% of the global offshore market, or India's pharmaceutical business is close to about 40% of US generics consumption, I think we are going to see that happen in a number of industries. We've also seen it with chemicals. So which is why we're fairly constructive on where the outlook is. And believe me, valuations are not demanding in most of these companies, most of these spaces out there. So going back to the corrections in the marketplace, I use it fairly productively, or to try and allocate a large part of capital today into the next couple of months, and the cheaper they get, the better it is.
Kenneth Andrade, it's a pleasure speaking with you. Thank you very much for providing us with a wealth of your experience and